What if I told you there's a single decision about your money that 99% of people get wrong, and it's the main thing standing between them and actual wealth? It has nothing to do with picking hot stocks or perfectly timing the market. It's a simple, almost invisible shift in how you hold your money. In this video, I'm going to pull back the curtain on this huge mistake and show you the simple portfolio tweak that separates the wealthy from everyone else. A change you can make in the next 10 minutes that will completely change your financial life. To really get this, let me introduce you to two people. We'll call them David and Mark. David and Mark are pretty much the same person. They went to the same college, landed similar jobs in the same field, and they both pull in a solid $80,000 a year. Both are responsible guys. They don't spend like crazy, and they both diligently save money from every single paycheck. On the surface, you'd think their financial futures would be identical, but flash forward 20 years and the difference is jaw-dropping. David is still grinding away, feeling like he's just treading water. He's got a decent pile of cash saved up, but he doesn't feel wealthy. He still worries about retirement, about a surprise car repair, and about how everything costs more each year. He's comfortable, but he's not free. Mark, on the other hand, is living in a different reality. He has options. He has real security. He could quit his job tomorrow if he wanted to, not because he hit the lottery, but because he built a machine that makes money for him. His net worth isn't just double David's, it's 10 times bigger. So what on earth happened? Same income, same starting line. The difference wasn't luck. It was one crucial misunderstanding that David and 99% of people fall for, and it's the very first reason most people fail to build wealth. The single biggest mistake, the one that created that massive gap between David and Mark, is this: David thinks saving cash is how you build wealth. Mark knows that's how you lose it. Let that sink in for a second. The one thing that feels so responsible, piling up cash in a savings account, is a guaranteed way to lose your purchasing power over time. This is the simple portfolio shift. It's not about complicated trades, it's about the ratio of cash to assets you own. Here's how it went for David. Every month he proudly transferred $1,000 into his savings account. He loved watching that number climb: $12,000 in a year, $120,000 in a decade. It felt safe, tangible. His portfolio, if you want to call it that, was 90% cash. He thought he was winning, but he was playing a losing game. Why? One word: inflation. Even with a modest 3% inflation rate, his $120,000 saved over 10 years can buy way less than when he started. The dollars are there, but what they can do has shrunk. While he was earning interest, the cost of housing, healthcare, and everything else was growing much faster. He was trying to fill a bucket that had a hole in the bottom. Saving cash gives you a safety net, but it doesn't build wealth. Mark got this from day one. He knew cash was a tool for emergencies and short-term goals, not a long-term strategy, so he made the shift. First, he built an emergency fund, about 6 months of living expenses, and kept that in a high-yield savings account. That was his cushion. But every single dollar after that went into a different bucket, not a saving bucket, but an owning bucket. Mark's portfolio was the reverse of David's: 10% in cash and 90% in assets. He started buying things that grow faster than inflation. He wasn't some stock-picking genius. He just bought simple, low-cost index funds, specifically funds that track the entire stock market, like an S&P 500 ETF. This is the portfolio shift, moving from being a saver of currency to an owner of businesses. When you own an S&P 500 index fund, you own a tiny piece of the 500 biggest companies in America. Their growth is your growth. While David's cash was quietly eroding, Mark's assets were compounding. That's the magic that happens when your investments make money, and then that money starts making more money. It's a snowball effect that over 20 years creates an avalanche of wealth. Let's run the numbers. The stock market has historically returned around 9–10% per year on average. After 20 years of saving $1,000 a month, David, even in a high-yield savings account, might have around $260,000. It's a nice sum, but its buying power is a lot weaker. Mark, by investing that same $1,000 a month and earning a hypothetical 9% average annual return, would have over $660,000. That is a life-changing difference. And it all came from one decision: to be an owner, not a saver. The biggest risk isn't a market crash, it's the slow, silent certainty of inflation eating your cash. Playing it safe is one of the riskiest long-term moves you can make. This leads right into the second reason most people never get rich. Because David's whole strategy was based on saving, his only way to get more money was to work more. He was stuck on the hamster wheel of trading his time for dollars. If David wanted to speed things up, what could he do? Work overtime, hunt for a promotion, or get a new, higher-paying job? All of those things have a ceiling. There are only 24 hours in a day and only so high a salary for his job. His income was always tied directly to his labor. You work, you get paid. You stop working, the money stops. Mark, by focusing on owning assets, was building a second income stream, a passive one. His portfolio was like an army of little employees working for him 24/7, even while he slept. These employees made him money in two ways: capital appreciation, the value of his investments going up, and dividends, companies sharing profits with him. He understood that real wealth isn't about how much you earn, but about how much your money earns. He was systematically separating his financial survival from the hours he punched on a clock. While David was trying to get a 5% raise, Mark was focused on growing his asset base by 10%. It's a completely different game. David's goal was a bigger paycheck. Mark's goal was to buy more assets that produce paychecks. This is a huge mental shift. Most people see their job as their only source of income. The wealthy see their job as seed money for their real income generator, their portfolio. They use money from their day job to buy assets that will eventually make that day job optional. David was working for his money, Mark was making his money work for him. Okay, so if the answer is just invest, why doesn't everyone do it? This brings us to the third massive roadblock. People are paralyzed by fear and complexity. Think about David. He hears investing and his brain flashes to guys in suits yelling on Wall Street, confusing charts with zigzagging lines and scary headlines about market crashes. It feels completely overwhelming. The fear of losing the money he worked so hard to save is so strong that it pushes him to make the most common decision: no decision. He stays in cash, telling himself it's the safe move. This is analysis paralysis, and it kills more financial dreams than anything else. People think you have to be a genius to invest, that you have to find the next Amazon. That's a myth. The truth is, building wealth is usually pretty boring. This is where Mark again took a different path. He didn't try to be a hero. He embraced the boring but proven path. As we said, he just consistently bought broad market index funds. An index fund just tracks a market index like the S&P 500. By buying one share, you are instantly diversified across 500 of the biggest US companies. You don't have to analyze a single company. You just bet on the long-term growth of the economy as a whole. Mark's strategy wasn't about being smart, it was about being disciplined. He used a technique called dollar cost averaging. That's just a fancy term for investing a fixed amount of money on a regular schedule, no matter what the market is doing. That $1,000 a month went into his investment account like clockwork. When the market was up, his $1,000 bought fewer shares. When the market was down, his $1,000 bought more shares at a discount. While some studies show that investing a lump sum right away technically wins out about 2/3 of the time, DCA is a powerful strategy because it automates the process and removes emotion. Mark wasn't trying to time the market, he was focused on time in the market. The fear of a crash is real, but it's short-sighted. History shows us that while markets crash, they have always recovered and reached new highs. Panic selling during a dip is how you lock in permanent losses. Staying the course is how you build wealth. Mark understood that a market dip isn't a disaster, it's a discount. It's a sale on the world's greatest assets. Alright, if you're getting value from this, do me a quick favor and hit that like button. It really helps the channel and lets me know you want more content like this. And I have to ask, which of these mistakes have you struggled with? The saver's mindset, the fear? Let me know in the comments. No judgment here, we're all learning together. The fourth reason people fail is a total misunderstanding of debt. For most people like David, debt is just something you use to buy stuff. When David got a raise, he decided he deserved a new car, so he financed it for 72 months. The car was shiny, but it was a depreciating asset. It lost value the second he drove it off the lot. He used credit cards for vacations and gadgets. He was always paying interest on things that were worth less over time. This is bad debt, it makes you poorer. Mark saw debt differently. He knew there are two kinds, bad debt and good debt. He avoided bad debt like the plague. He drove a reliable car he paid cash for. He never carried a credit card balance. His rule was simple: if it's not going to make you money, don't borrow money for it. But he also knew good debt could be a powerful tool. Good debt is borrowing money to buy an asset that goes up in value or generates income. A classic example is a mortgage on a rental property. You borrow money to buy a house, the tenants pay your mortgage, and the house hopefully appreciates. You're using the bank's money to get rich. Now you don't have to get into real estate. It's the mindset that matters. Mark saw debt as a strategic tool for acquiring assets, not a shortcut to a fancy lifestyle. David was paying interest to look rich. Mark was avoiding that interest so he could one day be rich. That distinction is everything. This brings us to the silent wealth killer, the one that sneaks up on almost everyone: lifestyle inflation. Remember, David and Mark both started at $80,000. Let's say after 5 years they were both making $110,000, an extra $30,000 a year. What did David do? He moved to a nicer apartment. He got a more expensive car. He started eating out more and buying designer clothes. His spending rose right alongside his income. So even though he was making way more money, his savings rate, that $1,000 a month, stayed exactly the same. He felt richer, but his journey to freedom had stalled. He was just running faster on the same hamster wheel. Mark took a radically different approach. When he got that same raise, he did something most people would find insane. He changed nothing. He kept living in the same apartment, driving the same car, and sticking to the same budget. He took the entire post-tax difference from his raise, let's call it $1,800 a month, and shoveled it straight into his investments. His investment contributions instantly jumped from $1,000 a month to $2,800. Do you see the power in that? David increased his spending. Mark increased his rate of investing. While David was showing off his new car, Mark was quietly building a machine that would buy his freedom. This single habit, delaying gratification and investing your raises, is the ultimate financial cheat code. David let his lifestyle eat his income. Mark fed his income to his portfolio, and it grew into a monster. There's one final piece to this puzzle, a legal hack the wealthy use that most people ignore: tax-advantaged investment accounts. Let's say David eventually started investing. He opened a standard brokerage account and bought some stocks. Every year he'd get a tax bill for any dividends he received. When he sold something for a profit, he'd pay capital gains tax. These taxes create a small but constant drag on his growth. Mark knew the government actually wants you to invest for the future and offers incredible incentives to do it. He made it his top priority to max out these accounts first. He started with his company's 401k, especially up to the employer match. An employer match is literally free money. If your company offers a match and you're not taking it, you are turning down a 100% return on your money. It's the best deal in finance. Inside a traditional 401k or IRA, his investments grew tax-deferred, meaning he paid no taxes year after year, allowing his money to compound much faster. Even better, Mark used a Roth IRA. With a Roth, you put in money you've already paid taxes on. But here's the magic: all of the growth for the rest of your life is 100% tax-free. When he retires and withdraws that money, the government can't touch a penny. Imagine that $660,000 portfolio we talked about. In a Roth, it's all his. This is a game changer that many people simply don't take full advantage of. So let's step back. The massive gap between David and Mark wasn't about Mark being smarter, luckier, or earning way more money. It was about a series of simple, disciplined choices. He shifted from being a saver to an owner, letting his money grow through assets. He focused on building passive income so he wasn't forever trading time for money. He ignored the noise and fear, using a simple, proven strategy of consistent investing. He avoided bad debt and saw good debt as a strategic tool. He fought lifestyle inflation, investing his raises instead of spending them. And he used legal tax advantages to supercharge his growth. These aren't secrets for the super-rich. This is a blueprint. The difference between the 99% who struggle and the 1% who succeed isn't access, it's application. It's not about genius, it's about discipline. It's not about timing the market, it's about time in the market. You have the blueprint now. You can be David, feeling safe with a pile of cash while its value evaporates, or you can make the shift today and start building your own wealth machine. The choice is yours. Don't wait, your journey to becoming Mark starts now.